Why is it me? Why am I that guy? I still buy low, still sell high.
I'd like to welcome everyone to the Tortoise and Hare Financial Podcast. I'm your host, Jim, and joining me today is my co-host, Ryan. Ryan, how are things going today?
Doing great. It's still beautiful out, and I feel like we haven't done this in a while, and I'm starting to get the summer, shake it off the summer, and get back into recording some more of these podcasts because people still are talking about wanting to learn more from some of the podcasts that we've been doing. So it's great to hear some positive feedback. So
yeah, you're right, and I see you got all dressed up for the occasion today, which is awesome. I love the shirt.
that's right. Nice linen shirt. Keep the summer breezy going. So
Yeah, and I think I was telling you that today is probably the first day in a few years that I'm literally at home all by myself. My Carol is on a New York trip with her friend, well-deserved trip. Kids are at school, and I almost considered starting this podcast like Tom Cruise in Risky Business, right? For any of you who don't know, he comes in with, was it old-time rock and roll? He's got the shades on, he's got the shirt on, he's in his tighty whities and his socks, right? Yeah. And he's singing that song. So I almost came into the podcast doing that. And I thought, there might be younger kids watching the show. So
yeah, I'm pretty sure a lot of people are very grateful for that. But maybe we'll have to try a new intro at some point. So
that's a good point. So today we're talking about portfolio reviews and the importance of portfolio reviews. And one of the reason why it's prompted us to have this conversation is, really the last year and a half, the markets have been quite volatile. Yeah. And I kind of point out to the recent inflation numbers again. Just recently they announced that it's kind of crept up from it was a 2.8 in June. Now it's back up to about 4. Mm-hmm. And that's really been causing a lot of volatility in people's portfolios. And so, really to kind of do a portfolio review is almost like a maintenance on your vehicle. Just to make sure that everything's running properly, the way it's supposed to, just to make sure that it lines up still with your goals and your risk profile. Yeah. And it also lines up with the fact that you and I are now offering a complimentary portfolio review offering, and we'll talk about that a little bit later on in the show itself.
Yeah.
So, let's talk about, the kind of basic what really is a portfolio review and why should someone do it. Quite frankly, let's take a look at, your mutual fund portfolio, your stock portfolio, whatever investment assets that you have. Yeah. And see, first of all, if you're well diversified. Yeah. We're finding right now that a lot of people actually aren't. Making sure that, you are holding the right type of assets in that portfolio. And again, the right type of assets in terms of meeting your volatility or your risk profile.
Yeah.
Right. So what we generally do is we ask for information and we do an analysis.
Yeah. Yeah. I think when you talk about well diversified, I think a lot of people just think by having numerous different types of risk in mutual funds, that's diversity, whether it's high or low risk. But I think one of the things that we do and the program that we're just complimentary offering to people too is digging deeper than more than just simply investing in one or two different stock options. Mm-hmm. And even within the mutual fund portfolios that you see, when you actually look at what the portfolio is and how they're built, there's not much difference between high risk and low risk. They're often, spending the money on the same companies, the same stocks within the market, but that there's other ways to diversify. And that's where we come in to kind of look at and strategize with people other ways to take a little bit of risk, but also, as we've been staying true to, which is slow and steady wins the race, right? And regular reviews. That's the other thing that I find with clients is often they are kind of in a set it and forget it mode. Mm-hmm. They go to their bank and, 5, 10 years go by That's usually the range that I find a lot of clients. They haven't seen or talked to their bank rep in at least 5 years and talked about how their goals have changed. And
Mhm.
now they're 5 years older and maybe perhaps they have children, or they're looking to buy a home or a secondary property, and how each of those things are so important for a regular review. And as you said, car maintenance. So whenever you do your oil change, you know, 3 to 4 times a year, it's probably about the same time you should mark something in your calendar to talk to your financial person, right? And talk about how are things performing and are my goals changing. So
Yeah, and maybe we can talk about some examples that we've come across in the past when we've completed a portfolio review, and maybe some kind of misconceptions about a portfolio review. The first one for me, quite honestly, that I've seen throughout the years is I'd ask a client about diversification.
mhm.
I think you kind of touched on this a little bit. And a client would say, "Oh, I'm well diversified. I have 25 or 30 different mutual funds with 5 different mutual fund companies. So I'm clearly well diversified."
Yeah,
And then we run the portfolio analysis, and what we'll find is they have 5 different companies that, mutual fund companies that are managing 20 or 30 different mutual funds. But when you kind of bring it all together, they're all invested in the similar stock
mhm.
or basket of stocks, similar type of bonds, and they're really not well diversified. They're in their asset classes are the same, the stock positions are the same, and then when you point that out, most people will be surprised
Yeah.
that they thought that they were well diversified, and they're actually not.
And
So
you're
that's a common one for me.
yeah, and by doing so, when the market takes a hit, your whole portfolio takes a hit versus
Yeah,
actually creating an actual proper portfolio that sometimes isn't always reacting to the market, is protected from the market perhaps, and really making sure that your goals are being achieved at a pace that makes you comfortable. And one of the things that we've talked about before and encourage people to understand is rates of return, and making sure that you're not just chasing a singular number, because clients often come to us and to me for sure and say, my friend is getting 22% return
Mhm.
on their portfolio, but when the market is down, that same friend isn't running to them sharing my portfolio is down 42% in the market.
Yeah.
And that says a lot about somebody when doing a portfolio review too, is what kind of risk are you truly willing to take when it comes down to it. And there's a lot of great programs that we use to help compare, and portfolio managers help compare how your portfolio is doing in comparison to others.
Mhm.
How sometimes it's just a couple little tweaks, or sometimes it's a full restructuring of it.
Yeah.
That's part of the discovery of doing these reviews, and that doesn't have to be a big deal for a lot of people, but you know that we can work through any process and help them achieve
Yeah.
that goal instead of chasing a different goal that somebody else is trying to set for them. So
Yeah. Yeah, and the other diversification aspect too, going back to diversification, is in a typical mutual fund portfolio, balanced mandate, for example, you know, they might be invested in 5, maybe 6 different asset classes.
mhm,
And a lot of the portfolio managers that we work with, typically are at a 10 to 12 different assets that they're diversified into for a client. So again, what that really speaks to is, we talk about risk.
mhm,
Really, it's about volatility.
yeah,
That's the type of risk that we're referring to. And when you're concentrated in certain asset classes, there's going to be more swings up and down.
mhm,
And what I will say is that people typically don't question their portfolio when things are going well, like in 2021, for example.
mhm,
But then they start to see the volatility going in the wrong direction, and people start to panic and become emotional and tend to make the wrong decision.
Mm-hmm.
So for us, really, our strategy is we want to look for, to try to minimize that volatility, the swings one way or another, try to keep it more consistent, going back to the tortoise and the hare strategy that we referred to.
Yeah.
Right? Another area that I found that comes to a surprise with a lot of clients, and this has been happening recently, is when we talk about their portfolio with a mutual fund or however it might be structured or placed, and they'll say to me things like, "We're not paying any fees for our investment."
Mm-hmm.
Well, that's not true. In a mutual fund portfolio, there are embedded fees. Typically they're 2% plus, and I will point that out just in conversation. Like, no, I don't see any fees coming out of my account, therefore I'm not paying any fees.
Mm-hmm.
So part of the process of going through a portfolio review is also identifying, here's what your actual cost is. This is what you are paying for this portfolio. Doesn't mean there's anything wrong with it,
Mm-hmm.
but just be aware of it. And in many cases, with a lot of the partners that we work with, they also offer a lower fee than what is offered through a mutual fund. Have you come across those situations as well?
Yeah, absolutely. And to add to that too, I find in my previous experience with dealing with, for instance, banks, is they're not always upfront where the fees are, and hidden deep on page 22 of 23 when they send you your big pamphlet, right? But ourselves and the portfolio managers we work with, it's usually one of the first conversations. Here is it up front. It's not hidden. You know what it is. And again, as you just said, often I don't think I've in the last year or so run into a situation that these fees that are talked about are better than what you're getting at something that's very passive through offering from a bank, right? So not only are you getting sound advice, somebody that's going to be able to connect with you and talk through and talk about your goals versus a very passive kind of set it and forget it, and then having a reaction to when the market is down instead of having somebody to come to and talk to about what it is, why are we keeping this strategy, why are things being tweaked along the way. And I think the portfolio managers do a great job that we work with in doing so. And that's why we're encouraging more reviews of what your current portfolio is and understanding what is your portfolio and how is it broken up. So, and where are you at risk?
Yeah, and I think too the big difference as well is when we're working with our clients, we're taking a holistic approach. We're not just focusing on necessarily the portfolio. That's what a lot of money managers do. That's what a lot of the banks tend to do, is focus on the account, not really looking at big picture.
Yeah.
For us, it's more of we're focusing on the big picture. And obviously the portfolio solution is part of that.
Yeah.
Right. Like just recently, I'm working with a client where they've gone to the bank. It's mother's money, mother's elderly, and they're placing all this money in an equity portfolio, a balanced mandate. Someone who's in her 80s, mid 80s.
Yeah.
And the first question I asked was, okay, well, from an estate point of view, are there any ways that they're going to help you avoid probate and the estate and some of those situations?
Yeah.
And it was amazing because the client responded, well, we talked about it, but they recommended that we don't go in joint name with the mother on the account because then it kind of opens up, tax problems for the beneficiaries or the potential beneficiaries, and also, marital problems potentially. So the advisor advised that they just put it in mom's name and have the estate pay probate and taxes. I remember even stepping back thinking, okay, well, so the individual's focusing on the portfolio, not looking at big picture, because we have solutions in that example where we can provide you with an investment portfolio that will bypass the estate and put more money back in the pockets of the beneficiaries as opposed to giving it to, external partners, for example.
Yeah.
That to me was just an example of an advisor who was focusing on just the portfolio itself and not really looking at big picture. So for going back to our approach, and even if we use the golf analogy, I think I've shared this with you before, right? If I were to say, Ryan, I'm going to send you to play in the Masters, which is golf's most prestigious event. And I said, Ryan, you're going to have the choice of one of two things. You either can have the best clubs that are currently available in the world, or you can have the ability of the best golfer who has ever lived. Which of the two would you choose?
I got this, Jim.
You got it? It's the ability.
Yeah.
Everyone says the ability. It's like, right, you have to know how to play the game.
Yeah.
What the banks are doing, and when we focus on just the portfolio piece as an example, that's the clubs. We need the clubs to play the game.
Yeah.
And the portfolio, the financial instruments, that's what they are. Those are the clubs. But no one's talking to clients about teaching them how to actually play golf.
Yeah.
And that's part of what we're trying to encourage people to do is learn how to play the game.
Yeah.
And then we'll match you up. And we want to do an analysis of your clubs.
Yeah.
But not only do we want to do the analysis of the clubs, has anyone actually taught you how to use them?
Yeah.
And that's, I think, the point that I'm trying to come across here.
Yeah.
That makes sense?
It does. And picking on the banks and CRA. CRA loves your success tax at the end of it when you're gone, right? So,
I love that. I never heard that before. Success tax.
Yes. So at the
I
end,
love that.
you're gonna pay this big tax to the CRA. They're gonna love you for it, but unless you've done the proper planning, and again, working through your portfolio, how everything is invested, whether it's mutual funds and stocks or insurance strategies, whatever's out there, you need to be able to have everything talking to each other. And I think that's the importance of working with TVH Financial Group is having everybody in the same room, being able to strategize for you. We were just talking with a couple yesterday after my softball game, and just talking about how they don't like going to their accountant for one thing, and then they suddenly go to their bank for another thing, and then they have to go to their broker for another thing, and this kind of mismatch of information, and that no one's talking to each other. But what if there is this magical place that that actually brought all that information together?
Does a place like that exist, Ryan?
I'm pretty sure there is. But it'd be amazing, right? That the accountant, who is very, for the most part, singular, thinking about you in this year, versus an accountant that works with a group that is thinking not only of this year, but how next year, the next 10 years, and even as your estate rolls out. And, getting to that age where a lot of family members, parents are passing away, and seeing kind of the heartache of not proper planning, and how throughout that, portfolio reviews are an important slice of the overall picture that people look at, and making sure that not half of it is taken by the CRA, right? Yeah. And instead we're leaving a legacy, whether it's our children or grandchildren or a great charity, perhaps your dog and cat at home, whatever it is. So again, we're talking about a specific thing about portfolio reviews today, but there is obviously a bigger picture that we want to continue to discuss along the way. So
for sure, we want to look at tax efficiencies, right?
Yeah.
Like right now, inflation is eating away at our wealth. Taxation is eating away at our wealth. So if there are more efficient ways of reducing tax, then we want to be able to take a look at that and offer that solution.
Yeah.
And in some portfolio structures, again, doing a recent review with a client, they were instructed that they should put their money in a certain asset class, but their money is sitting in a corporate account. And if they structure it the way it was recommended, then the passive income rules kick in for the corporation, and there are some significant penalties. So I had to step in and say, no, you can't do that for this reason. We have to restructure the portfolio.
Yeah.
Thankfully, they went through with the recommendation that I made, or else they would have had some major tax problems through the corporation. And here's another one. As I'm kind of thinking through some examples over the years, I don't know how many times I'd go through a know your client with a client, and I can see that they were a conservative investor or very, very safe investor. And I'd ask them, they'd say, well, yeah, I have money, a bunch of money in my mutual funds. And I'd ask what type of mutual funds that they were holding. And many times they would come back and say, well, they're very safe.
Yeah.
They're very safe. My advisor, I told them that I don't like taking a lot of risk, and they're very safe. And then I would take a look, just quickly do a glance of the holdings, and it would be like global science and tech, emerging market funds, and I'm sitting here, and I'd say, are you sure that you informed your advisor that you're a conservative investor? Absolutely. Why? Like, you're in higher risk investments. But in their mind, they thought they were in safe and secure investments. It's actually how, one of the things when Carol and I first started dating, before she met me, she was with another advisor through another investment firm. And, as I was starting to date and get to know Carol, I can kind of see she was a very conservative personality.
Yeah.
And we talked, it came up about her RSP portfolio at the time. It's like, yeah, I'm very safe and don't like taking a lot of risk. And sure enough, she finally gave me a statement and, global science and tech and all these other, and I'm like, whoa, like totally off.
Was that your first date or second date with Carol?
That was my second first date. I don't know if I told you that story. That was the second first date. Did I ever tell you that story?
No.
Just briefly?
No.
All right. So briefly, Carol and I had a first date.
Yeah.
And I dropped her off. She was staying with her aunt in Whitby, so I dropped her off at her aunt's house, and I said, okay, I'll call you. 4 years went by. And I attended the church that I was attending at the time, and I knew Carol through her cousin. That's how the connection, or that's where the connection was. So this one day, 4 years later, her cousin brought her to the church that I was attending because I was going to church in Ajax and Carol lived in Mississauga. And I saw Carol at church, but she didn't see me.
Yeah.
So I called her cousin. I said, hey, I saw Carol,
I've been in a coma
on a date. Yeah. No, I just said, would she, do you think she might be interested in going on a date with me again?
Yeah.
And sure enough, Carol agreed with it. And I remember on our second first date, she looked at me, we're having dinner, and she's like, I really hate when guys say they're going to call me and they never do.
Yeah.
And she's like, you did the same thing to me. And I said, well, I said I'd call you. I never said when. Right? So, but 4 years later, and then 3 months or 4 months after that second first date, we got engaged, and a year later got married. So obviously it worked out. Yeah. But so that was, in getting to know her, and she's one example. I mean, throughout the years, I don't know how many times I would meet with a client in their 70s, and they're like, yeah, I'm in a safe investment. Yeah. And I would see these high risk, very volatile investment holdings, small caps, oil and gas resources. I'm like, no. We really need to adjust that. And then going through the review itself, the portfolio analysis, we were able to show them, here's the risk profile that you're currently in today. Are you okay with this?
Yeah.
And I'll get, not guarantee, but 9 times out of 10, the client will respond with, no, absolutely not.
Yeah.
Well, this is how I think you actually should be invested. Does this make you more comfortable? They're like, absolutely. And what we present is what they thought that they had originally. And then
yeah.
Right? So another benefit of a portfolio review.
Yeah, absolutely.
And it's complimentary.
Yeah.
I mean, really, if we kind of go through the mechanics of the review, maybe you can kind of speak to this a little bit, Ryan.
Well, yeah, really it's about collecting the information of what you're currently invested in for us.
That information being statements, right?
Yeah, statements. Yeah,
that's all.
Sorry. And just understanding where your current risk is, and then for us, it's about bringing in the right portfolio manager to really talk more deeply about what that risk is for you. And as you just said, like, somebody can be on feeling like they're not very risky, but as we've learned, especially over the last couple of years, some people realize they can accept a lot more risk than they thought they could. And then for some, realizing they can accept, but it also depends on the stage of life you're at. And that's part of the mechanics of understanding your full portfolio review is there's so many factors. And this is why we want to make sure that people are doing this pretty regularly, as if they were doing an oil change, because so many things change with the market, with your own status, with your job, with having kids, with kids leaving the house, to preparing for retirement, to in retirement. Are you solo? Are you with a partner? Are there dependents? All these things play a part in understanding and doing a proper portfolio review. So I would challenge people out there, if the person that you're doing a review with or first introducing any of your options of mutual funds, stocks, or anything, isn't doing something along those lines and understanding you as a person and your goals, and then furthermore, checking in with you at minimum once a year, at minimum, then I think it's time to look for secondary opinions or advice. So through this journey.
And I think that's what we're offering right now is we might come out and present everything is fine. You're structured the exact same, the way that you should be. Yep. No changes are recommended. Just keep on the same path. And wouldn't you want to know that?
Yeah.
Right. But when would you want to know if things are offside and not structured the way that you want and potentially riskier than you had thought? Yeah. I think you'd want to know that sooner rather than later, like right away.
Yeah. And I find in, the clients that I've run into, often there's always two big ones. One, when somebody's looking to buy another property. And second, when somebody's looking at retirement.
Yeah.
And that's when clients come to us and often have a realization that they didn't do it often enough, or there was some mismanagement, or the right questions weren't being asked. And that's all we're asking. We're trying to educate people to do is make sure you're asking questions, that you're being part of the conversation, and that you're informing your own advisor, for that matter, of any big changes. And again, I will continue to say, and a client I was just talking to yesterday is making a pretty significant change in their life. And I was number 3 on their call list. And I always jokingly say I want to be in the top 5. So I got to number 3, Jim. So
hey, good for you.
Yeah. So it's important for people to go through this process more regularly than they are. And again, it's a little bit of time, but the reward in the long term can be, exponential. So
I just kind of thought about like using an analogy. It's like, you're planning a road trip. I don't know about you, but whenever I've planned road trips, I mean, I've driven across the country and northwestern Ontario and all those things.
Yeah.
I know what my destination is and I know what I have to do to get there. But one of the very important things that I do is I bring my car to the mechanic and get them to do a look over.
Yeah.
That's what the portfolio review really is. You know what? We know what the destination is. We know where we want to get to. We know some of the things we have to do to get there, some of the stops and all those things. Mm-hmm. That's the plan. That's the retirement plan, let's say. But what if your car breaks down? What if the engine blows up along the way? What if your tires go flat? And all you had to do was just bring it into the mechanic first, let them take it. It doesn't guarantee that those things won't happen. Mm-hmm. But if the mechanic has a look at it underneath the vehicle, in the engine, and all those things, and looks at the how the tires are, potentially can anticipate, hey, you need to do these things, or else you might have a blown tire or a blown engine or transmission or whatever else. That's the portfolio review.
Yeah.
Right.
Yeah.
And that's what we're offering right now. I try to simplify things for people, because I think by doing so, it helps them understand.
Yeah.
Right.
Oh. Yeah. Absolutely.
So it's not really an what's the word, onerous, or I don't know. It's not a difficult thing to do. We are offering, as I mentioned at the beginning, a current complimentary offer to anyone who would just like a second opinion. I'm almost certain that if you're dealing with a robo-advisor platform right now, you're not getting, an opinion on the structure. You're just basically being asked to complete a questionnaire, and they put you in these cookie cutter portfolios, and you really don't have a true understanding. So if you're just looking for a second opinion, it doesn't cost you anything. What I'm going to do is, we did create a landing page for people. I'll include the link in the description of our YouTube video as well as our podcast pieces. And just go to click the link, and it'll ask you to just provide us with your name and your email address. Then that'll take you to another section where we'll ask you to complete a disclosure document, just so you can understand, you're sharing your information with us, and and how we're protecting you, and all those things. And then there'll be an upload button on that page, on the second page. So you can just upload your statements. We'll receive them, and then what we'll do is we'll do the analysis and report back. And what we'll most likely want to do is schedule just a quick 30-minute Teams meeting, virtual meeting, just to go through the analysis, provide the client with a copy of the analysis, and that's it. Yeah. And if there's any recommendations, we'll make those recommendations at that time. The other way, we can complete a portfolio review is just by calling directly. So we can be reached at 647-727-4668. You can also email us, financial@tvhgroup.ca. And then, I'd also like to remind people, if you'd like to book an appointment with us, you can also do it through our mobile app. So we do offer a mobile app, TVH Financial. So take a look at that as well. Ryan, I don't know, is there kind of to summarize, end the session, anything else you want to add to the discussion today?
Well, after learning your story about Carol, I'd say sometimes you do get a second chance, and maybe this for some people is their second chance.
You're right. You're right. Just don't wait 4 years.
Yeah, don't wait 4 years. So, but yeah, just encourage anybody to carve out 30 minutes of their time to really just take a look at where they're going, and family members too, to make sure that they're on the right path. And that's pretty much it. So,
right. Awesome. Well, I guess then we can probably end this episode. So for all of you that are listening and or watching, thank you very much once again. We encourage you to share our episode as well with anyone that you think this might help out. And we encourage you to reach out to us if you have any questions. No expectation of anything. We're here as financial teachers, as I know Ryan has said in the past as well.
Yep.
So feel free to reach out to us. Ryan, I guess you enjoy the rest of your day today.
Thank you. You too, Jim.
Yeah. And until the next time.
Bye.